Week 8, and we're going to an entirely new subject. We're going to be talking about fringe benefits, and that's nothing to do with anything we talked about in the class before, and you're probably going to ask why we're covering it. Well, first of all, fringe benefits are taxable for most people, for most of the benefits they receive. There's roughly 150 to 160 different types of fringe benefits, of which only 20 have a tax advantage. And I think your clients should know when they're getting benefits that what they're paying for and what they're not paying for, because it's going to show up on their W-2 at the end of the year. And I find very few people other than engineers and accountants who really look at their W-2 to try and match it against what they think they earned for the year. And occasionally I'll have an engineer come into my office and say, the company's cheating me. They're charging me income of $12,000 more than I earned. And tell them very simply, well, that's because of fringe benefits. Or it could be the 401k plan that's reduced from your income, and that's deferred taxation. So again, I would like to have my clients know what they're getting and what they're paying for. Sometimes they get benefits they don't really want, and it's not worth what they're paying for it. Likewise, when I'm dealing with small businesses, again, those people I deal with insurance with, as well as the retirement plans that they should have or shouldn't have, maybe is a better way of putting it, we talk about what benefits are. And again, the company gets to tax deduct all the benefits. But even though it's a tax deduction for them, it's a cost of doing business. It reduces their profits. So they're looking for fringe benefits that give the most bang for the buck. They also want to make sure that management can benefit from it too, and that becomes part of the problem, because as we go through here we'll find that most benefits cannot be eligible for S corporation owners who also work for the company. They'll be taxed on it, and in many cases they're even disallowed from having it. We're also going to find that it's very difficult in many cases to have discrimination where executives get a better deal than the employees. So that sort of is a background. Let's get into the definition of fringe benefits. This is non-cash compensation benefits to employees, although there sometimes you will get cash, for example, on an employee award program where you get $50 or $100 for doing a patent or being employee of the year. But as a general rule, there's no cash compensation. There's other types of compensation. Most of these benefits are taxable to employees. Again, that shows up on the W-2 as additional gross income if it's done correctly. And I would say one of the problems we have in this country as a whole is very few payroll departments / HR departments really understand what fringe benefits should be taxable and what shouldn't. And again, if there's an audit by the IRS, the costs get disallowed. And we've also had cases where employees went to the IRS and said that the company was giving certain benefits to certain people and weren't being paid for. Sometimes they were correct and sometimes they weren't. Generally 2% owners of S corporations, I mentioned, sole proprietorships and partners must pay taxes on benefits, and discrimination rules are common for corporations and LLCs, etc. Check with your tax advisor for the latest IRS positions, because it does change. I know in the last few years there's been several significant changes, although in general certainly what we're going to cover didn't change, but if it is, we call it indexed, or we say in process of change or whatever. But it's something that you should always check with, especially if you own the company and you want to make sure you're paying your fair share of taxes. The IRS position: all fringe benefits provided by an employee are taxable as wages to the employee unless there's a specific provision of the IRC General Revenue Code that excludes the benefit from taxation, or the employee pays fair value for the benefit. So if you get a benefit and the employee pays fair value for it, no problem. Now, what is fair value? It's not what the employer paid for it. Employers many times buying in volume get big discounts. It's what's the fair market value. A fair market value is not retail price because, again, whatever the retail price means, list price or other terms they use, many times you can get a lot cheaper. So the real question is, what is the fair market value for it? And that sometimes it can be a litigation with the IRS if it's a substantial value. For de minimis values, they're not going to argue with you as long as you put something down. Let's see, and finally, the benefits are usually tax deductible for the employer, even if taxable to employee. And I can't think of any that would not be deductible for the employer unless it was something that benefited the owners. And there again, that would be because it should be treated as a constructive dividend. Non-discrimination rules. Some benefits cannot be discriminated among different classes of employees. If subject to non-discrimination rules and a benefit is as follows: it is discriminatory, first, only providing to highly compensated employees, or if not made available on substantially the same terms to all employees. If this is the case, the benefits are included in the highly compensated employee's gross income. And so I would say that, again, I would check. The IRS has pamphlets out for employers and employees on benefits, and your textbook talks about it. You might take a look at what it is for this year. Health and disability insurance. Employer can provide health and disability insurance to the employee. We're not sure what the impact is on Obamacare on that because we still don't have all the procedures out. So, and I would suspect, someone told me it's probably going to be 3 or 4 years before all of these procedures out. So it's probably going to be about 2017, 2018 before we'll really know for sure. Kind of scary, isn't that? It's covered in Module 2 in this course as a separate because it's part of usually group plans. Life insurance. Employee can receive up to $50,000 term life insurance. Amounts in excess of $50,000 will be taxed to the employer. And we have expanded coverage in Module 2 because, again, it's a group plan. Meals provided to employees. Employee can exclude from gross income the value of all meals provided to him, the spouse, and dependent, so long as both the following are met. Meals are furnished for the convenience of the employer, and meals are furnished on the employer's business premises. So one I've run into is companies that have picnics on Friday afternoons, and the employees are required to attend it, and they are encouraged very, very strongly to bring their spouse and dependents to it, and that is on the employee's grounds. It is going to be tax-free to the employees. Again, it would be for the convenience of the employer, which is building employee morale, etc., and furnished on the employees. But if you get it off the premises, let's say it's at a local park, then the issue is it absolutely required to attend? And if it's absolutely required, as opposed to suggested that you attend, then it would be taxed to you because it's not on the premises. Lodging provided by employer. The value of lodging furnished by an employer to an employee will be excluded from the employee's income if the following 3 conditions are met. Lodging is furnished on the employer's business premises. The lodging is furnished for the convenience of the employer, and the employer is required to accept the lodging as a condition of employment. That could be for a person of the cloth. It could be for someone who works for a hotel, such as a hotel manager. It could be for people who are firemen living at a fire station. In other words, we have to show it's on the business premises of the owner, it's furnished the convenience of the employer, and the employee is required to accept the lodging as a condition of employment. Many college students, while in college, work night shifts, as I guess they call them night accountants or something, handling the desk between, say, 11 o'clock at night and 6 or 7 in the morning, while normal people are sleeping, and they sometimes go at 11 o'clock. I mean, when they get off the shift at 7 or 6, go sack out in one of the rooms. If they do that, quite honestly, they're liable to be taxed for the value of that room, even though they may only be there for a couple hours getting a slight nap and maybe a shower before going off to classes. That's a surprise to some people. Now, that's what the rules are. I've heard of several cases, including my brother, who never got charged anything, even though every day they slept there. But again, if we follow the tax rules, it would be charged to the employee as price of the room. Value of on-premises athletic facilities. The value of an on-premise athletic facility provided by an employer to employees is not included in the employee's income if, first, the on-premise athletic facility is operated by the employer, the facility is located on the employer's premises, and substantially all of the use of the facility is employees of the employer, the spouses, and dependent children. So if you get sent to Gold Gym by your company, you're going to pay the cost of the fair market value of the fees for being at Gold's Gym, because it's not an employee's facility. Let's say there's a gym and facility on your premises at work, and they allow suppliers and clients to also use it. It's going to not be deductible for you, because there must be use for the facility by the employees and by the spouses and dependent children, no one else. Very strict on that rule. And so don't be surprised if you get charged for that athletic facility fees. Education assistance programs. Programs require a written plan. Plan must only provide for educational assistance. The maximum assistance for gross income exclusion is $52.50. That's been there for a long time, even though the cost of education is going up drastically. And if, let's say, the employer pays you $10,000, $52.50 of it is tax-free. The $47.50 remaining is going to be taxable income to you, and you'll be paying taxes on it on your W-2. Dependent care assistance. Service must be provided for a qualifying person. The services must allow for the employee to work. The employee can exclude a maximum of $5,000, and plan must provide beneficiaries with advance notice of the program. There are companies that do this. Here in California, it's extremely rare because of the insurance liability. I know several companies who tried it and had to pull it out when they saw the amount of liability insurance included. And it's for the workers. Now, if someone is looking for a job and has someone care, that doesn't count. It's got to be where they actually allowed for the employee to work, and that benefit from the employer is to a maximum value of $5,000. Now, if you've had children in daycare, you know $5,000 doesn't go very far, especially if the children are there from 7 in the morning to you get off work at 6 or 7 at night. Therefore, you're going to probably be paying something on tax on it. No additional cost services. Service provided cannot cause the employer to incur any substantial cost or lose revenue. Services must be one offered to customers in the line of business in which the employer performs substantial services. Typical one for this would be an employee works for an airline, and his flight is from New York to Miami. He lives in San Francisco, so he gets a flight from San Francisco to New York, and then goes to work from New York to Miami, then flies back to San Francisco. That cost of going from to and from work in New York and Miami is not taxable, as long as he doesn't take a seat of a paying passenger. So if it's a full plane, bad news. If it's not a full plane, good news. Also, apparently, relatives can do the same on this. It also applies to bus and railroads, but I don't know who would want to take a bus ride or even a railroad ride if they were employer of the company. And again, it's just designed for that transportation area. Employee discount programs. Discounts in this area, I might note, first of all, it's changed a lot over the years. Today's rule is discounts do not apply to discounts on real property or on personal property commonly held for investment purposes. The exclusion is limited to the lesser of 20% of the price in which the service is offered to non-employees. And so if I'm getting a haircut and I work at the barber shop, I get 20% off what the non-employees pay. If I get more than that off, I get taxed on it. And if I work for Nordstrom's and merchandise or other property, the employee's gross profit percentage multiplied by the price of the employer charge non-employee customers of the property. Again, this is pretty simple. If we have a gross margin of 30% and we give 30% or less off to employees, there's no tax on it. If our gross margin is less than 30%, less than 30%, and we give it to the employees at 30%, then there would be some tax involved. And employers are pretty close at watching it because, again, this is published information. It's very easy for the IRS to check it out. Working condition fringe benefits. The following working condition benefits are excluded from income. Any property or services provided by an employer that enables the employee to perform his work, and if paid for by the employee, would be deductible as a trade or business expense. So a company might provide you a phone, they might provide you a computer that you're to use. In the old days, it used to be briefcases. Today, I guess it's backpacks that are provided. These are the types of things that included. Maybe if you are working in an area where there's heavy snow and they have special boots that allow you to get around better outside, and you're working outside, that might be also an example of working condition fringe benefits. In other words, tied to the fringe benefits. De minimis benefits, items so small in value that accounting for it would be unreasonable or administratively impractical. Some de minimis benefits may also be excluded from an employee's gross income under other regulations, such as exclusion of employer-paid meals. So the coffee you get at work for free, or maybe you get bagels on Fridays for free from the employer, he gives it to you. Use of the telephone for personal calls, use of the computer for, I guess, whatever you use it for other than for work. These are examples of de minimis benefits. Also making copies of machine on the copy machine at work, and a lot of employers let you take your pens from work home so you can use them for school or home. Oh, again, not going to be charged for it. Moving expenses could be services in kind, direct payment, or reimbursement. All three apply. Criteria for tax-free benefit is what would have been deductible under the employee's tax return had it not been reimbursed. Well, those of you who took the course in income tax are aware that you don't get a lot reimbursed. That is tax deductible for the individual, which means many of the business moving expenses that are made to get the employees to move are going to be taxed to you. For example, such things as 6 weeks to find a house, or maybe some people get 6 months free lease so that they can find a house. Some people get part of their brokerage fees paid. All of these things are going to be taxable in your tax payment. It surprises some people when they get this astronomical W-2. That's when they notice the W-2. Probably the first time ever pay attention to it, thinking it's an error. Transportation parking. The exclusion for transportation benefits is subject to the following limits, and that's a 2007. I believe it's still the same, but because it's been there for so long, I just didn't check to see what it is for this year, but certainly you can look it up in your book. It is not an index value. It's been a constant for a long time. $110 per month for computer highway transportation and transit pass combined, or $215 a month for qualified parking. And if you park in downtown LA, it isn't going to pay your whole bill, believe me. And neither is the computer highway transportation. Note that any given month, if the value of a benefit is more than the limit, then any excess amount above the limit, less any amount the employee pays, is included in the employee's income. The excess does not qualify as de minimis, and it's basically there's no rollover from month to month. Adoption assistance program. Exclusion from income is the amount paid or expenses incurred for each qualified adoption. It requires the employer have a written adoption assistance policy. Big emphasis is that it's got to be available to all employees, not just for executives. And to give you an idea, again, this number doesn't change a lot. It's not indexed. It's about $12,000 with a phase out, and a pretty good number. In fact, I would say of all of the tax credits you see, etc., this is probably the one program that is higher as far as income of adjusted gross income than others. And again, if it's changed very little because it's not an indexed amount. Employer provided awards. Employee achievement awards may be excluded from gross income and this is going to be a shock because most people feel that if they get an employee award, they don't pay taxes on it. But here's when you don't. An item of tangible personal property transferred by an employer to an employee for a length of service or safety. So it's got to be a length of service like 20 years, 30 years, 1 year, or for safety programs, we've had 6 months without an accident in the facility. Award is part of a meaningful presentation made usually in front of a group. Sometimes there's cake and coffee Sometimes there's even a meal. Some companies would be once a month, give a reward to anybody who has met the 1 year, 5 year, 10 year, 20 year, and to the organization that had the best safety record. So you got a meal with it. Awarded under conditions and circumstances that do not create a likelihood of appearance of payment of disguised compensation. So this is tangible personal property, which is used. Could be a ring or a brooch. Those are the types of things, typically a watch, not cash. Tuition reimbursement plans. If you, let's see, private schools is all this really applies to. I guess public schools could, but public schools don't. But private schools, and CRU does this. If you're an employee, and I'm not sure what the qualifications have been being an employee for this, but you get a tuition reduction plan because you work there, and that allows your children and spouse and former spouses, such as widows and dependent children or spouses, all to be able to take courses at the undergraduate level. The key is that they don't take a student out of the class. So if the room is set for 30 and there's 30 students, you cannot bump somebody for the spouse or children or former employees or even the current employee. But if there's room in the space in a room, say there's seating for 28 and there's only 25 in a room, then you can put the person in. And there are people, for example, who go to school while they're working at the university and get a degree. There are situations where former employees do it, qualified widows can do it, independent children or spouses. And I've always liked USC because of this program. University of Southern California has an excellent program. Even maids can do it. I had one situation where I had an administrative assistant. She and her 4 siblings all went to USC for free for 4 or 5 years to get their bachelor's degree because their mother worked there as a maid. Now the mother said she could have gotten a better job, better pay, but she wanted her children to go to college, and she got them through there because of this plan. So it's a tremendous plan, and makes up for some of the shortfalls. Now, if it's graduate school, that doesn't count. And I might note that if you work for an organization that's owned by the school, and the one I think of is JPL, owned by Caltech, that can also qualify other people for this. And that can be a tremendous savings for individual and expenses, as you can guess. So when people say, well, why are you working as a secretary at Cal Lutheran, or why are you working in some lower level job like that, rather than taking better pay for some other company? It's the benefit of the kids and yourself, maybe, or your spouse. Okay, cents per mile rule. Use of employee vehicles taxable for personal use of employee. Use of employer vehicles taxable for personal use by employee. So if you have a car that's provided to you, you have to keep track of that cost that's associated with work-related versus non-work-related. I actually was in a situation where I received a new car every 3 months. When I worked for Hughes Aircraft Company, they were owned by General Motors, and General Motors would give us cars for us to test and evaluate. And we could use it for personal use or business use. It didn't matter, because we were testing and evaluating a car made by our company, which was General Motors. That was a nice benefit, and I didn't have to pay anything for it. And in fact, if I remember, most of the time we got free gas if we were able to stop at the gas stand, which was nice because I was working 35, 40 miles away from the employer, from my house. The standard IRS mileage rate multiplied by the total miles the employee drives for personal use is used in case, again, that it's the employer's providing a vehicle and they don't make the vehicles, or you don't work for a division of a company that makes the vehicles. I guess that's a good reason to work for a company that makes vehicles, so that you can get the free use of the vehicle, because it's worth a lot of money, let's face it. And if you don't believe me, take a look at what you're paying for the use of a company vehicle that they give you, because anything that isn't work related is going to be taxed to you. Commuting rule. $1.50 a mile for a one-way commute. Don't ask me why it's one-way commute from home to work. And that you have to ask Congress why they did that. And that's a non-taxable benefit if the employer provided a vehicle for use in performing company business that requires the employee to commute for bona fide purposes. Written policy on personal use for commuting. And third requirement is employee uses for business-related commuting and de minimis personal use only, which means you don't use that van on the weekends. That's in the car for the carpool. And finally, cannot be a highly compensated employee. Can you imagine having your general manager driving the van pool for you, or being in your van pool? That would be interesting too. In fact, I would probably pay to see that. But again, if they're highly compensated, do not benefit from it. And these are generally for van pools, let's face it. Lease value rule. Value of an employee provided automobiles determined by using the automobile's annual lease value for determining taxable income. And again, there's so many different lease values. That becomes an interesting negotiation between the IRS and the company when you're talking about a lot of automobiles, because let's face it, every lease value is different per car. Valuation of fringe benefits. Taxable fringe benefits are to be valued at employee taxable income purposes at the fair market value, not the cost of the employer. And with that, we're done with Module 1.